ChargePoint has been one of the exciting stocks that has been riding this electric vehicle trend. But is it a great buy now, or is this a stock that investors should simply avoid? Well, I'm going to answer that and explain to you exactly how ChargePoint makes money, and that may or may not change your mind about this stock. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. First of all, let's look at some baseline numbers for ChargePoint. This is a chart that simply shows ChargePoint's market cap, revenue over the last 12 months, and net income. You can see that the market cap is about 14 times revenue. So that's a pretty expensive multiple, especially at times when investors are questioning multiples even for growth stocks. But the shocking number here is that over the last 12 months, ChargePoint has lost $311 million on the income statement, almost as much as it has generated in revenue. Now, I want to get to why that's important in just a second, but I think this is a good way to ground our view of a company like ChargePoint. The next thing to look at here is exactly how ChargePoint makes money, because I think a lot of people think that ChargePoint is making money every time you plug your vehicle into a charger, but it's really not. It's making a vast majority of its money by selling the charger itself. So let's get into these numbers. This is from the most recent income statement. Network charging systems generated $84.1 million in revenue. Subscriptions were $20 million, a little over $20 million in revenue. You can see that cost of revenue was $74.3 million on the network charging system side. So not a very high margin there, only under 15%. And subscriptions, a significantly higher margin business, but clearly a much smaller business as well. So what exactly are those businesses? Well, this is from the SEC filing. This is where ChargePoint explains exactly what network charging systems are. And you can see that they consist of the deliveries of EV charging system infrastructure, which includes level 2 and level 3 chargers to commercial and fleet applications. And they generate revenue or book that revenue upon shipment to the customer. On the subscription side, this is where they're making money off of the cloud, extended maintenance service plans, and what they call ChargePoint as a service for ChargePoint's owned and operated systems. So when you look at ChargePoint's revenue and margin, the $84 million number is not the subscription revenue, the ongoing revenue. It's the subscription number. It's the smaller number that's that ongoing revenue. That's what investors should be really worried about in growing over time. Before we get to what I think is some of the weakness in the business, I think it's worth thinking about ChargePoint's strategic position in the industry. Is this a valuable segment of the market, building EV chargers or even owning EV chargers and just selling electricity to customers? I think that's pretty questionable. And I want to go to part of a press release from General Motors in 2021 when they announced a big EV charging infrastructure that ChargePoint was part of. You can see here when they announced their Hoium Charge 360, this is a network of third-party chargers that GM is going to have access to, but they're going to be accessing them through the GM app. GM is going to take payments, and then they're going to pay those third-party chargers. Now, ChargePoint is one of these companies along with Blink Charging, EVgo, Green Lots, and a number of others. So just looking at this press release, you can see that ChargePoint is effectively a commodity to General Motors. And this really makes sense because ChargePoint is making a commodity product, a charger, and selling a commodity product, electricity, which is what ends up going in the vehicle. I don't really know that there's any strategic value there of one charger over another. That brings us back to the valuation of the stock. $4.6 billion for a company that's burning money and generating only about $20 million per quarter in recurring revenue is really not a very good valuation at all. In fact, that's an incredibly expensive stock. I would question at the current cash burn rate, I don't know that ChargePoint is going to be able to survive long term without raising a significant amount of cash from investors and also growing the business. Doing both of those things is very difficult. And so this is simply a stock that I would stay out of at this point. It may be exciting to look at electric vehicle stocks and see charging and think that there's a lot of growth there, but I think there's simply not a lot of money to be made in making either chargers or selling electricity through those chargers. And if there's not a lot of money to be made, there's not a lot of reason to value a stock like this really highly. That's why I don't think investors should be taking a risk on ChargePoint or Blink Charging or any of the other charging stocks that are out there. They're just simply too unproven. And until they can be viewed as value stocks that can generate recurring revenue year after year and generate a profit from that, it's simply a space I'm going to stay out of. What do you think? Do you think I have this take right, or am I wrong? Leave a comment in the comment section below. Give this video a like, and of course, subscribe to the Rive Project. It really helps people find the show. Thank you for watching, and I'll see you again next time.